name is Paul Barron. Welcome back into Tech Path. Joining me today is Darius Dale, who is the CEO over at 42 Macro. Been on the show many times. Welcome back.
Paul, it's a great pleasure to be here, my friend. Happy holidays.
Yes, thank you. Thank you. We're going to touch on a few pieces of notes here. One, of course, is CPE, of course, came in, or PCE came in 3.2% year over year in November. And I wanted to show this chart just to kind of show the dip that we're experiencing right now. With this being the case around PCE and the likelihood, because I think a lot of people thought it was going to come in soft and it did. What was your opinion of this? How much of an impact do you feel this really has on the market?
Yeah, no, it's confirming of the current Goldilocks top-down market regime that we've been pricing for a little bit over a month now, about 5-6 weeks, in our opinion, and that's likely to persist because most of the data from a qualitative side standpoint continues to support that Goldilocks expectation. If you think about what's happened in the last kind of 6 to 8 weeks in economic speak, we've seen a rising probability of a soft landing here in the U.S. economy, not the least of which is this morning's PCE report. Paul, I have a chart I can show you in terms of how we analyze the PCE report through the lens of 3-month momentum, 6-month momentum, and then ultimately year-over-year rate of change. And right now, we're seeing 3-month annualized and 6-month annualized rates of change. Those are 2.1% and 1.9% respectively. They're sort of coalescing around this 2% inflation target that the Fed wants. So we ultimately know that the year-over-year rate of change, which is the red line here in this chart, is likely to head it lower in the months and quarters ahead. Should ultimately help the Fed, it really does support that soft landing pricing that we're continuing to see in asset markets.
Okay, I hate to even say this, that the Fed has orchestrated a soft landing, or really looking like it could orchestrate a soft landing. I want to go to this tweet right here. This is from Kobe Easy Letter. And it basically says, markets are now priced in 86% chance that rate cuts are going to begin in 2024, but first quarter, March. Then you've got base case now showing potentially 7 interest rate cuts in 2024. If you asked me that 6 months ago, I don't think anybody would have said this. What do you think has changed in the last 6 months that would cause, first of all, the data to continue to move in this direction and the response that we've seen in the markets and with the Fed? What are your thoughts?
Yeah, 100%. You're spot on. 6 months ago, we did not have enough economic data on hand that would support a reasonably elevated probability of a soft landing. But within the last 6 months, we have accumulated such data, none more important from my perspective than the bounce that we saw in productivity growth going back to October 31st. We got the Q3 GDP report then and the productivity data then. And what we found is that, we're now tracking slightly above trend with respect to productivity growth, growing at about 2.4% year over year. That compares to our long run mean of productivity growth of about 1.7%. And the reason that matters is several reasons. One, productivity growth, now that it's back at a more healthy level, allows that, kind of takes the pressure off of corporate margins and ultimately takes the pressure off of corporations in terms of passing on price increases to their customers. Productivity growth, the improvement in productivity growth also improves the corporate margin outlook from the perspective of profitability. So ultimately, if you think about corporate profits hanging in there and actually accelerating pretty sharply, going back to yesterday's GDP report, we saw NIPA corporate profits accelerate to 13.7% 3-month annualized. That's the fastest rate we've seen since the beginning of 2022. So the improvement in profitability, the improvement in productivity are effectively telling corporations, sending a signal to corporations that they no longer have to pass on price increases as much as they have been in recent years. And their desire to cut costs is actually lower because their profitability is improving. So that's why we are seeing a rising probability of a soft landing. And this is data that we did not have on hand, let's call it 6 months ago.
All right, so companies obviously responding to this. You saw the data coming in on FedEx here this week. Their stock took a pretty hard hit. Likelihood in terms of their outlook, not quite as rosy. And I also look at a number of companies that have done pretty massive layoffs as well to, one, kind of counteract the issue that their own company is facing in terms of profitability. When you look at earnings season coming up in really the first 2 weeks, 3 weeks of January, I think January 12th is when all the banks report. What is your outlook for what we'll see, especially around these earning reports coming in the first of the year?
Yeah, we're going to see better earnings. I mean, we're already seeing that in the corporate profitability data. If you look at our corporate profitability model, we use this to track kind of broader margin trends in the U.S. economy. We look at the spread between gross domestic income growth minus the spread between unit labor costs and productivity, and that model has improved for 2 consecutive quarters and should support continued acceleration in earnings growth.
Okay.
I recall earnings bottomed in the second quarter of this year, and consensus does have earnings growth accelerating pretty linearly from that point over the next 12 months. But the reality is that should be happening, and if it does happen, it's a good thing, not a bad thing.
All right, for sure. I want to play a clip for you. I like the outlook because I think this is important to really understand what are some bullish signals for next year, 2024. Earnings will be one of the triggers I feel like is going to continue to give us more bullish signals going into 2024. The other thing that trails on that I'm not quite so driven on, and I'll ask you about that in a minute, is around labor. But before I do that, I want to show a clip here. And this from 7 months ago. And it's funny how things have changed so much, but I want to play this for you guys. Listen in. Great opportunity for, these are the times when great wealth is made.
100%. And just let me clarify. Our analysis suggests that the most likely quarter in which a recession is going to commence is Q4 of this year. The second most likely quarter is Q1 of next year. And so even if it's Q4 or Q1, we're still sitting here talking May 11th. That's a lot of time and space to trade between now and then. And you could easily see a short squeeze, that ends at the market on its highs right before that process, just like we saw in 2007.
All right, so you had some statements there that were very interesting. One was the short squeeze, potentially markets at all-time highs right before. Are you worried at all about, because right now we've got S&P breaking records here, we've got all sorts of bullish signals and indicators in the crypto markets. Are you worried about any potential, market correction right now in early or even mid 2024?
Yeah, you have to be worried about a market correction, but that doesn't mean you need to do anything about it today. One of the things, I think there's so many, if I can just take a step back in terms of, how we think about investing, how we think about investing at 42 Macro is we want to be making money all the time. I think a lot of other investors, think about investing is they want to be right on their thesis at some future point in time. And that to me is just not a palatable way of investing. It certainly won't get you paid on the buy side and help you maintain a buy side seat. So we try to orient our subscribers and our clients around, okay, how do we make money now? And ultimately, how are we, booking those gains at appropriate times when the facts change. And, going back to that clip we just is highlighted, we were highlighting that the probability, we did our frequentist probability study on yield curve control back last fall. That study said, hey, look, if you look at the historical lags between yield curve inversion and the commencement of recession, it's usually about, in the 13 to 18 month forward window of time, which coincided with that Q4 and Q1 expectation back then. That was not to say there was 100% probability of a recession commencing, but this is the window of time you needed to be worried about. Well, guess what? We're in the window of time we need to be worried about, and our Bayesian analysis of all the economic data continues to support that we don't need to be worried about it, right? If the productivity data did the exact opposite of what we're talking about, if core PCE was the exact opposite of what we're talking about today, then we'd say, hey, we are in this window of weakness. We need to be on high alert for a recession starting. That's exactly the opposite of what we've been coaching our clients at 42 Macro since the beginning of November.
All right, so you're definitely bullish here, Darius. I like it.
Ragingly bullish since November 1st. Ragingly bullish since November 1st. I can't make that more clear.
Yeah, I like your blog post. First of all, if you guys are not following Darius and 42 Macro, just visit 42macro.com. This is right there from their blog. What does the future hold for the U.S. economy? I want to highlight a few things here. Income-driven business cycle versus a credit-driven business cycle. Explain that for some of our people that maybe don't understand that.
Yeah, 100%. So a lot of investors have been focused on the lags with respect to monetary tightening and how that's likely to flow through to credit growth and ultimately cause a recession in the economy. The reality is this has been an income-driven business cycle. We have not seen credit growth outpace GDP growth at all throughout this entire business cycle. So that tells you that income has been the driving force of economic activity. And the reality is, as long as income continues to hang in there, the business cycle itself is going to continue to hang in there. And obviously, we are monitoring the income data in the jobs report, monitoring the income data in this morning's PCE report. Nominal disposable personal income is at an at-trend level, 4.9% 3-month annualized. Real disposable personal income, ex-transfer receipts, accelerated to plus 3% 3-month annualized. That's well above historical trends. So we have plenty of income support to continue perpetuating this business cycle forward.
Okay. Other things, can I hit on that? Softening in labor market conditions, specifically in terms of reduction in labor demand, indicated total job openings, not total employment, is significant and suggests that the labor market is cooling without a considerable increase in unemployment. That is a hard thing to do. And I hate to give the Fed the credit for this, but how did they pull this off? Is what I want to know.
Let's be clear. I wouldn't say they pulled it off yet, right? Like you notice when we talk, and you've heard me speak many times now. We never say this is going to happen. We say this is a high probability outcome. This is a low probability outcome. Right now, the probability, or really since the late October when we started getting some of these signals from an economic standpoint, the probability of a soft landing has risen materially, and its rise has come at the expense of both a no landing or in the hard landing scenarios. That does not necessarily mean the soft landing will be the ultimate outcome, but it is the outcome that the markets are keen to price in along the way. And it's our job to make money as a function of that as investors.
Yeah.
Going back to your point in terms of the Fed pulling off the soft landing. So let's throw some numbers on this. The Fed, if you look at the last 9 tightening cycles, which is all we have data for in terms of the Fed funds rate, 2 of those tightening cycles have ended up in a soft landing. And how did you wind up in a soft landing? Well, there's 3 things you need, or you need 2 of these 3 things to occur to wind up in a soft landing. Because if you don't have at least 2 of these 3 things, you always wind up in recession. At least that's what the data suggests. And one of those things is Fed pivots to rate cuts pretty expeditiously and starts to ease monetary policy without a material lag. That's exactly what we saw in the mid-'80s.
Right.
That's exactly what we saw in the mid-'90s in terms of those soft landings, which are the only 2 soft landings we have on record.
Mm-hmm.
And then you also need either some combination of above trend fiscal spending. If you look at the mid-'80s, we were growing well above trend in terms of government purchases and investments for multiple years there, which ultimately supported the economy through that tightening cycle. And then in the mid-'90s, the third thing that you need 2 of those 3 things for is a sustained improvement in productivity growth. And that's exactly what we saw in the mid-'90s all the way through the late '90s, given the development of the internet and all the associated applications. So you can make the case that we're probably seeing some version of all that right now, right? You have pivoting the rate cuts. You got the boom, or not a boom, but you have a acceleration in productivity growth that might be sustained because of AI. And then ultimately you have above trend spending and government spending, which is unlikely to go below trend heading into a recession with an incumbent Democrat president.
There's a lot of...
I say recession? Heading into an election, not a recession. Heading into an election.
And I think you're right. There's a lot of things that are really kind of landing at the same time. So kind of that perfect storm that really is lining up here. This is another feature I think that a lot of people have not been paying a lot of attention to, but it is clear now that we've seen obviously the central bank tightening so significant over the last 18 months. There's still a lot of liquidity on the sidelines. When you think about that, the amount of liquidity and $3 trillion higher than what it was in January of 20. So to me, obviously liquidity up, people are going to be looking for opportunities here, whether it's in the stock market, other investment classes, crypto also up and on a tear over the last 3-4 months. When would the real pivot occur for liquidity to come rushing in? Do you feel like this is more deep into 2024 or earlier 2024?
Well, the one thing I'll say is that I think that analysis is somewhat flawed. Liquidity is always being used. It's either being repoed out or it's being used to capitalize some on the asset side of someone's balance sheet. So, it's not like, that liquidity is going to go from where it is today and all into the stock market and go back to zero.
Yeah.
No. So that's a weird way to think about it, which we would, tend to disagree with. But I think the broader point is true, which is investor allocations to cash and liquidity like instruments have gone up materially in the last, 2.5 years. And if we soft land this plane, and not we, the Fed, if the Fed manages to soft land this plane, there are still a cohort of investors that are still pigeonholed in the no landing camp, and there are a cohort of investors that are pigeonholed in the hard landing camp. And both of those cohorts of investors need to get into the soft landing camp if that ultimately winds up becoming the outcome. And right now, it is the highest probability outcome.
Interesting. Okay. With that all playing into it, we've got a Bitcoin ETF really at the threshold of possibly getting approved. We
Hmm.
saw quite a bit of advertising already starting to kick off. This was the Bitwise commercial. I don't know if you saw this with the most interesting man in the world. But these early indicators, these are very fun to watch. But point being is there's a lot of early indicators here. Larry Fink, continuing to kind of massage the deal between what BlackRock is doing and the SEC. Do you feel like this is going to have a big impact on Bitcoin primarily with the ETF actually rolling out and getting approved if it truly does get approved?
Yes and no. It's going to be a structural inflow to the asset class. Doesn't mean that those structural inflows all need to come on the day the ETF gets approved. So
Right.
it's a positive long-term benefit. It's definitely not negative, but that doesn't necessarily mean that a lot of it hasn't been front run and it's in the price already, or at least the early wave of adoption is probably already in the price. Now, the
Mm-hmm.
secondary and tertiary waves of adoption may not be in the price, and that's more of a longer-term upside catalyst for the asset class. But that doesn't necessarily mean, at the end of the day, I think we do ourselves a disservice at times as investors of pigeonholing ourselves into these, monochrome, sort of these singular topics. It's the ETF. The launch of an ETF is not the only thing that's going to impact the Bitcoin asset class. There are a myriad of other principal components of macro that are driving that asset class: liquidity, growth, inflation, policy,
Right.
fiscal policy, monetary policy. Those things don't cease to exist because there's an ETF, and I want to make sure investors are very well aware of that.
Well, I think from the crypto side of the market, you just see that narrative being painted out, and in the crypto side, narrative pretty much controls price action to a certain extent, and definitely investor sentiment. But to your point, it doesn't necessarily give it long-term legs in terms of a potential asset class that's truly going to grow. We still need all of those other critical, tent poles of advancement in the tech, obviously adoption, and what we'll see in terms of now Wall Street getting into the game, which will be interesting, playing forward within that. Beyond crypto and beyond blockchain, you talked a little bit about AI being a big stimulus for possibly increasing productivity and continuing us on down the path. Some people think that's the answer to our situation in terms of debt. You look at this right here, just in Nancy Pelosi purchased $5 million worth of Nvidia call options.
Ooh.
Isn't that interesting? All right, Darius, the question of the day, is it time to get risky in the markets? Is now the time to deploy a little bit more aggressively? I'm looking here at the S&P chart, and you can kind of see, all the way back to October 27th was really when this little party began over the last 2 months, an absolute skyrocket from S&P in terms of performance. Is this a time to get risky? Is it time to maybe go on into some risk assets or maybe get more aggressive? If you're not into risk assets, you get more aggressive in your investing strategy overall.
Tactically, no. I mean, tactically, from a very short-term perspective, this market is obviously overbought. Like, a blind monkey can tell you that the market is overbought. You should probably, if you're going to be accumulating on down days or at the bare minimum dollar cost
Right.
average over a multi-week period. If you find yourself underinvested, which, by the way, you didn't have to be underinvested. You could have gotten all these signals from us in real time. I'm talking to you, viewer. When we pivoted back at the beginning of November, a lot of folks missed that pivot, and the reason they missed that pivot is because they're not being Bayesian and systematic about their research and risk management processes. They're being confirmation bias oriented about their research and risk management processes. And so if you think about this on a medium term duration, our quantitative risk management systems, namely our global macro risk matrix and our macro weather model, those are our two most important systems that, help keep our clients on the right side of market risk. Those systems are still quite bullish. We should be expecting positive market outcomes over the medium term. That doesn't necessarily mean that next week the market has to go up or the week after the market has to go up. If anything, you want to be buying those dips if we did see a pullback from this overbought condition.
Yeah, very interesting times right now, Darius. So always fun getting you on the show. We appreciate you stopping in. If you guys have not checked out 42macro.com, go over and visit the website. You can get a chance to see Darius in a full suit there. I like that.
That should be 10 trillion now. We just got a new very big client, so we're
oh, nice.
World, man.
You're rocking it over there, my man. Do it.
Yeah.
This is going to be a good year. I'm going to be very happy to have you back on the show as things start to heat up for us. But anyway, thanks again. Have a Merry Christmas, and we'll catch you in 2024.
Paul, always a pleasure, man. Happy holidays to you and your family, and thank you again for all the opportunities, man. You have a great audience and a great platform. Appreciate you.
All right, you bet. All right, you guys are tuned in. Maybe on the podcast side of things, jump over here to the YouTube channel, catch everything right here. All you have to do is of course, search Paul Bear Network. You'll find us. Get into the Diamond Circle too. It's one of our best tools out there in terms of communicating with our audience, and it's a great place to catch additional alpha and podcast, all sorts of research, cool tools I think you guys will love. All you have to do is click the link down below to get involved in that. If you guys want to catch me on X, it's at Paul Barron. We'll catch you next time right here on TechPath.